Okay. Okay. Is it done? Okay. Hello, everyone. Good morning. Welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president. And it's our privilege today to host Federal Reserve Governor Christopher Waller for a speech and a discussion of his outlook on the U.S. economy and monetary policy. This is, I believe, the second time we're having Governor Waller since he became a member of the Federal Reserve Board, and we're excited to welcome him back. I think everyone recognizes that Chris has been a significant intellectual leader on the FOMC since his arrival, including his notable call a year plus ago about the beverage curve and the possibility of seeing disinflation without a significant rise in unemployment. But obviously his interests and his influence extend far beyond that issue. Just for the record, Christopher Waller took office as a member of the Board of Governors starting in December of 2020. And if he's willing, he gets to serve until January 2030. Prior to his appointment to the Board of Governors, Chris was a distinguished civil servant in the Federal Reserve System as Executive Vice President and Director of Research at the Federal Reserve Bank of St. Louis starting in 2009. Prior to that, Dr. Waller had a distinguished academic career serving as a professor in Gilbert F. Schaefer Chair of Economics at the University of Notre Dame. He was also, befitting someone who comes to talk at the Peterson Institute for International Economics, a research fellow with Notre Dame's Kellogg Institute for International Studies, and previously had been a research fellow at the Center for European Integration Studies at the University of Bonn, a noted think tank in Europe. He also has previously served at Indiana University's Department of Economics and at the University of Kentucky. We will get right into it. We have a lot of distinguished and influential Fed watchers both here today and online, and I'm looking forward to both Governor Waller's remarks and our subsequent discussion. Thank you so much for joining us.
Well, good morning, everyone. Thank you for coming. Thank you, Adam, and thank you for the opportunity to speak here today. The Peterson Institute is renowned for its valuable contributions to research and its influence on economic policy. There really is no better place for a central banker to come and talk about the outlook for the U.S. economy and the implications for monetary policy. It truly is a pleasure to be here. Peterson was also the host for my very first speech as a governor back in early 2021, which unfortunately was virtual. So after an eventful 3 years, it's nice to be back and in person. So after a run of great data in the latter half of 2023, it seemed that significant progress on inflation would continue and that rate cuts were not far off. However, the first 3 months of 2024 threw cold water on that outlook, as data on both inflation and economic activity came in much hotter than anticipated. Initially, it seemed like the bad data might simply be a bump in the road. But as the data continued to point in the wrong direction, the narrative quickly turned towards concerns that the economy was not cooling as needed to keep inflation moving down towards the Federal Open Market Committee's 2% goal. Progress on inflation appeared to have stalled, and there were fears that it might actually be accelerating. Suddenly, public debate became whether monetary policy was restrictive enough and if rate hikes should be back on the table. But more recent data on the economy indicate that restrictive monetary policy is helping to cool off aggregate demand, and the inflation data for April suggests that progress towards 2% has likely resumed. Central bankers should never say never, but the data suggests that inflation isn't accelerating, and I believe that further increases in the policy rate are probably unnecessary. Let me turn to the data we have seen since the last FOMC meeting. Real gross domestic product, or GDP, grew at about a 4% annual pace in the second half of 2023. And that stepped down to 1.6% in the first quarter of this year. That looks like the kind of moderation that would support progress on inflation. But it was mostly due to two components that tend to be volatile and not reflect fundamental growth: trading goods and services and additions to inventories. Private domestic final purchases, which is often a better signal of the underlying strength of the economy, grew 3.1% in the first 3 months of this year, almost exactly the pace in the second half of 2023. I will be watching closely to see whether this measure of economic activity in the first quarter continues into the second. The blue chip consensus of private sector forecasts projects real GDP growth of 2.1% this quarter, with only a slight moderation in personal consumption expenditures, or PCE, from the first quarter. Others, like the Atlanta Fed's GDP Now model, have a higher forecast. Nevertheless, there are several reasons why I do expect some moderation in economic activity. One sign of moderation is that retail sales were flat in April and revised down in the previous 2 months. Retail sales are an important component of consumer spending, so this suggests that consumers may be tempering their purchases. We have also seen credit card and auto loan delinquency rates rise above their pre-pandemic levels, which indicates that some consumer segments are under stress to support their spending levels. That said, services spending data are continuing to look solid and should hold up overall spending in this quarter. Now, another sign of moderation in the economy comes from the Institute for Supply Management's, or ISM, survey of purchasing managers, those who make spending and investment decisions for businesses. For the first time in 4 years, the indexes for surveys of both manufacturing and non-manufacturing businesses slipped below 50 in April, indicating that production in these businesses was contracting. Now, this wasn't surprising for manufacturing, since they have been reporting weakness in employment and inventories for some time. The surprise was that the survey of non-manufacturing businesses, representing the lion's share of U.S. output, fell below 50, indicating a deceleration in activity. This has not happened since December of 2022. ISM results can move around from month to month, but if these numbers are sustained, it would be indicative of slowing economic activity beyond manufacturing. 1 month does not constitute a trend, but this data suggests that policy is doing its job to moderate aggregate demand, which will support renewed progress in lowering inflation. Now, let me speak about the labor market. The labor market is still relatively strong and supporting a solid pace of job creation. But after progress in bringing demand and supply into better balance in 2023, this rebalancing seemed to stall at the beginning of this year. Then in the past month or two, the easing of demand relative to supply seems to have resumed. The hiring rate, reported by the Labor Department, slowed relative to the previous 3 months. In March, the share of workers who voluntarily quit their jobs declined, with the quits rate falling below pre-pandemic levels. This is a sign that fewer workers are jumping to a new and usually higher paying job. This means firms are in less need to fill vacancies and offer relatively high starting salaries, something that could continue to support moderating wage increases. Job creation fell from 315,000 in March to 175,000 in April. Now, a big reason for the decline was a sharp drop in the pace of job creation by state and local governments that is unlikely to be repeated. But private sector job creation also fell, another indication that demand for workers continues to slow. That was also the message I take from the unemployment rate in April, which ticked up to 3.9%. It was the 27th consecutive month that unemployment has been below 4%, the longest stretch in decades. but it still stands noticeably higher than the 3.4% rate last April. Meanwhile, the ratio of job vacancies to people looking for work fell to 1.3, just 1/10 of a point above the pre-pandemic level, and a sign that the relative shortage of workers related to the pandemic is close to over. Wage growth is still a bit higher than I believe is needed to be consistent with our 2% target. But it's not that high, and recent average hourly earnings data suggests that wage growth is moderating. And some measures of wage growth that tend to be forward-looking have also continued to slow on balance. So just like the data on economic activity, I see the labor market data supporting renewed progress towards lowering inflation. So now let me turn to the outlook for inflation. Last week's report on Consumer Price Index, or CPI inflation, in April was a welcome relief after 3 months without any progress towards 2%. That said, the progress was so modest that it did not change my view that I still need to see more evidence of moderating inflation before supporting any easing of monetary policy. If I were still a professor and had to assign a grade to this inflation report, it would be a C+. Far from failing, but not stellar either. Headline CPI inflation rose 0.31% month over month. Notice we're starting to report these in 2 decimals. That barely budged the 12-month total CPI inflation rating to 3.4% in April from 3.5% in March. More importantly, for the inflation outlook, core CPI inflation, which excludes food and energy prices, came in at 0.29, down from 0.36 in March, and 12-month core CPI fell to 3.6 from 3.8. Accounting for price data from the report last week on the Producer Price Index, forecasts are predicting both monthly headline and core inflation based on PCE, or personal consumption expenditures, which is the FOMC's preferred gauge, rose a bit less than CPI last month. Most forecasts for monthly core PCE seem to be in the range of 0.23 to 0.26, which is less than March's monthly increase of 0.32. Now, although both March and April may round to 0.3%, it's good to see monthly inflation falling, even if it requires looking out to the second decimal point. So looking across these estimates, they suggest 3-month annualized core PCE inflation could decline around a full 1 percentage point to about 3.4% as the outsized January increase rolls off the 3-month average. Like the CPI numbers, this is not where I want to see inflation. But after having these 3-month readings accelerate in January, February, and March, I'm happy to see a reversal in this recent pattern. It leaves me hopeful that progress toward 2% inflation is back on track. Now, before I say more about the implications for policy, this seems like a good moment to make a few points about a bedrock principle of monetary policy: data dependence. The appropriate setting of monetary policy requires understanding how the economy is performing and some idea of where we think it is going. The latter typically means making a forecast or a projection based on standard macroeconomic models of key variables and what that implies for policy. But this forecast must be validated by the data. The economy is dynamic, and sometimes new or revised data can significantly change one's understanding of economic conditions and the outlook, which has implications for monetary policy. Now, one data point alone should not change one's view of the economy, and that is why changes in one's outlook and the appropriate path for policy tend to emerge gradually and over time. While you may have confidence in your forecast, incoming data may challenge that confidence. You neither want to overreact to incoming data, nor do you want to ignore it. I'm bringing this up because I hear from some quarters that claim that the FOMC has become overly data dependent. This is a phrase I honestly doesn't make sense to me because apparently it's supposed to mean that we are overreacting to the data and allegedly sending confusing messages about the stance of monetary policy. I don't see how that argument applies to the views of the FOMC if one looks at the Summary of Economic Projections, or SEP. Between the March SEP in 2023 and the March 2024 SEP, the committee median was relatively consistent in projecting around 3 rate cuts in 2024. This was in the face of some pretty dramatic shocks to the economy. There were the bank failures and wider stress in the financial system in the spring of 23, when it was far from clear what the ultimate effects would be on the economy. There were significant fluctuations in inflation, which was hot in the first half of last year and then dramatically cooled in the second half. There was a revelation over time and in different data that a surge in immigration was augmenting labor supply and allowing a surge in job growth with very little upward pressure on wages and inflation. And then there were geopolitical developments, such as the threat that war in the Middle East might spread to become a wider conflict. Against this backdrop, the median FOMC participant only gradually reduced their expectation for unemployment, the unemployment rate at the end of 24, and essentially left inflation unchanged. Associated with this outlook, the median projection for the appropriate level of the federal funds rate moved by at most 50 basis points between the 4 SEPs over 2024, and more or less held to the median of 3 25 basis point rate cuts over the past year. Now, this hardly seems like overly data dependent to me. For illustration purposes, contrast that with how the private sector reacted to developments in 2023. The implied federal funds rate based on overnight interest rate swap quotes for the end of 2024 seesawed between 2 rate cuts and 10 rate cuts. For a few days, markets even predicted 11 rate cuts. And by the end of 23, ended up implying 6 rate cuts. So tremendous volatility in what the markets were pricing in for rate cuts. I make this comparison not to denigrate what markets were doing. They were simply revising their forecasts and their accompanying risk outlook based on the data to maximize the value of their trading books. My point is that the approach of the FOMC is to set policy appropriately to achieve our dual mandate. And typically, that requires us to move gradually, extract the signal from noise from the incoming data, and then adjust policy. Based on the evidence over the past year, I see nothing excessive about our data dependence when projecting the appropriate policy path. So let me now turn to the implications for monetary policy of my outlook for the U.S. economy. With the labor market as strong as it is, my focus remains on bringing inflation down to the FOMC's 2% goal. The latest CPI data was a reassuring signal that inflation is not accelerating. And data on spending and the labor market suggests to me that monetary policy is at an appropriate setting to put downward pressure on inflation. While the April data represents progress, the amount of progress was small, reflected in the fact that I needed to report the monthly numbers to 2 decimal places to show progress. The economy now seems to be evolving a bit closer to what the committee expected. Nevertheless, in the absence of significant weakening in the labor market, I need to see several more months of good inflation data before I would be comfortable supporting and easing in the stance of monetary policy. Now, what do I mean by good data? What grade do I need to give future inflation reports? I'll keep that to myself for now. But let's just say that I look forward to the day when I don't have to go out 2 or 3 decimal places in the monthly inflation data to find the good news. Thank you.
Chris, I'll put it there. Get your water.
Oh, thank you. I'm assuming this side's okay.
That's the right side, so to speak. Anyway, thank you for being back. And yes, we are proud that we were host of your first speech, but we're happier to do it in person, as are you. Very forthright, very topical comments, obviously, Chris. And I think everyone appreciates your taking on directly both the performance on inflation in recent months, but also the discussion around data dependence. I think you were pretty clear about what you are looking at, what you're looking for, but as you make your own vote and your own assessment, obviously. But just let me go back. I mean, you did seem to be speaking very much in a Phillips curve kind of framework, that a key determinant of inflation is slack or lack of slack, labor market growth rate. So how much do you think the inflation that's come down even to the C+ grade level was due to standard sort of disinflationary effects for monetary policy? I mean, was there slowing growth or obviously not much rising unemployment? I mean, what was the mechanism bringing down inflation as far as it has come?
Yeah, so I typically think of monetary policy as working to slow demand. And if you slow demand, that's obviously going to put some pressure on labor demand. But whether that means you have to lay off workers or not is a different statement. And that was one of the things I saw back in 22, May of 22, was the standard view and the standard model would say, in order to bring down aggregate demand, you're going to push down labor demand and you're going to cause firms to lay off their workers. That's the standard kind of Phillips curve story. Most of the time, that may not be a bad model to think about things. But in the spring of 22, all of my anecdotal conversations with businesses or soft data, all I heard was, I can't hire workers. I'm fighting to keep the workers I've got. So in my head, I thought, how could it be that that's what firms are telling me, but we're saying as economists, that the first thing they're going to do is fire their workers? It just didn't seem to match up. So I took the view that we could actually lower labor demand through vacancies as opposed to actually reducing employment. That was very controversial, as you know, because it really hadn't happened in the past. But we were in such a strange circumstance in the spring of 22 that this seemed like an obvious way, given what I was hearing from the business sector, of what would happen. So I made an argument that we could raise interest rates, push down aggregate demand, push down labor demand, but it would show up mainly through reduced vacancies, not in unemployment or layoffs. Like I said, very controversial at the time, didn't go along with what the standard models would tell you to do, but that's one thing I learned in this pandemic. A lot of the things that we think are standard relationships weren't quite working the way they had in the past. So 2 years on, it's May 2024. Like I said, the vacancy to unemployment number of people looking for a job was 2 back in spring of 22. So for every 2 jobs that were open, there was only 1 person available to fill it. Now that number's down to 1.3. It was 1.2 in 2019. So it's pretty much come down, and unemployment has stayed roughly in the high 3s. So that prediction seemed to have been borne out.
No, I give you a lot of credit, as do our colleagues like Olivier Blanchard, who debated it with you. Can I just ask you to follow up on that a little bit? As you said, it was quite unusual to see such a huge shift up and back in the beverage curve, as we call it, the relationship between vacancy and unemployment. So more generally, is this something you think central bankers need to think about as a recurrent thing, or is it really a special circumstance kind of thing that we just need to keep in the back of our minds?
Yeah, so that's the thing. We had never seen that kind of vacancy to unemployment rate, a number of unemployed before. It really was an extreme outlier, and that's where the debate was really focused on, was the beverage curve shifted far to the right, which was Olivier and Larry Summers' view,
right,
or my view and Andrew Figueroa's view that you're really just on the very steep portion of the, this thing is nonlinear in theory. Right. And it gets very steep as unemployment gets very low. So we were arguing just on this steep part and meant that you could kind of bring it down as long as there wasn't a big increase in involuntary separations, which again sounded crazy to me given what I was hearing from businesses.
Right.
That we could pull this off, and it seemed to work. In this Fed's note that Andrew and I put out, we did say that once you get down to kind of the pre-pandemic levels, the old normal relationships are likely to start happening. So it's not like we can continue from here out counting on vacancies absorbing any further decreases. We're getting to that point where the traditional relationships are going to start popping out.
Great. One thing you didn't talk much about during your opening remarks is that financial conditions in the U.S. economy measured various ways. I tend to focus on credit spreads, which by standards of tightening cycles have remained pretty narrow. Financial conditions, variously measured, don't seem to have tightened very much, despite the Fed's raising rates as much as it has. Why do you think that is, and how much does it matter?
Yeah, so looking at financial conditions, which is a broad-based measure of things, I think sometimes is helpful, sometimes it can be misleading, particularly if it's just focusing on stock prices, which some of the indices have a strong weight. I mean, if I look back to 23 and I see AI blowing up the Magnificent Seven and that's driving the stock market, I don't know what that has to do with me and thinking about housing prices or anything like that. The other thing that clearly seems to have happened is that the probability of a recession seems to have disappeared off the table. Once that happens, you should see stock prices go up. You should see credit spreads go down because the danger has gone away, not disappeared, but gone away. So some of this is not surprising just by the fact that the economy looks like we're not going to go into a recession, independent of whether it was our behavior or anything else. But you look at the real 10-year Treasury rate, and that has gone up. It went way up in the fall, came down, and now it's gone up probably a good 80 basis points since December. And that's where I think you're going to see potential effects on tightening, not so much in stock prices or credit spreads, but just the fact that the level of real interest rates is much higher than it was. I also find it kind of an odd thing to think about. We were accused of loosening financial conditions in December, and that led to this boom in economic activity in the first quarter. Whatever happened to long and variable lags?
Right.
I mean, on the way up when you're raising rates, it's going to take 18 months for that to do anything. But apparently when we talk about cutting it, it's instant. It's the next quarter. So there's just kind of a disconnect between how people think about rate hikes and rate cuts in terms of how soon it impacts the economy. So again, I'm not putting much stock in the fact that any loosening in conditions had anything to do with what happened in the first quarter.
Great. Again, let me just follow up on that. So in terms of lagged effects, so is it that we expect to see more effects of the tightening in the rest of this calendar year in terms of impact on the real economy? And this was something some of your colleagues in the FOMC were talking about some months ago. Does this mean you should be further out in front in terms of loosening, counting on real rates defined by the 10-year Treasury tightening as much as they have?
Yeah, so the whole debate about how long and variable the lags are is an ancient question. There are reasons why you could say they're shorter than normal. I gave a speech last summer kind of making that argument. There are others who said they're longer than normal because of strange behaviors in the housing market where everybody's locked in and nobody's getting rid of their houses, that there's less interest sensitivity in some sectors than there used to be. I mean, trying to figure out what the actual lag is very difficult to do. So when you have that much uncertainty about what the lag is, I think you have to be a lot more cautious about what you do now, thinking about what the lag might be. Now, we just finished rate cuts last July, so it hasn't even been a full year since we kind of hit the peak rate. So there is a good chance that some more influence, and that's kind of what we're counting on. More downward pressure will happen over the incoming months. But I don't think it's so high that we're going to crash the economy, and I don't think anybody in the markets does either.
Another thing which you didn't make much of in your opening remarks, but I know you've spoken about in the past, is the concept of R-star, the neutral rate for the economy. All of us have enjoyed, since Chair Powell's Jackson Hole speech about following the stars in the cloudy skies, and I'm not going to do justice to the metaphor, but it does seem to be a useful organizing concept for thinking about some long-term things. So first, is it useful for policymakers or is it an academic distraction? And second, as we watch the forecast in the dots of the 10-year Treasury rate go up a little bit, is that representative of the committee's views on R-star in some sense, or is that a separate matter?
Yeah, so some free advertising. I'm going to give a speech on Friday on R-star if you're looking for something to do Friday morning.
You can come back and give it here again.
So, I mean, the general sense is it a useful concept for thinking about policy? Yes, in the long run. And I think of it in a very simple way, which is if we are hitting our goals, inflation is stable, unemployment is at full employment, what should the policy rate be?
Right.
To answer that, you got to have some measure of the real policy rate. And that's, you just have to. Otherwise, you don't really know where you're going. So I find it is a useful concept. Is it hard to measure? Absolutely. Do we see anything in the real data that tells us what this is? No. So it's always going to be some measure with uncertainty around it that you kind of have to accept. But the discussion lately that has been going up, I'm like, okay, I'm willing to entertain it. But this thing is, by a lot of different measures, been falling for 40 years. What suddenly changed economically for this thing to turn and go back up? You can't just say, my gut instinct is, I think it's higher.
Right.
You can't do policy that way. You either have to say, this is the reasons I think it's higher, and then look at the data to do that. So I just don't like people saying, oh, I think it's higher now. The other thing I find a little tough to do is when people start talking about, oh, there's long-run R-star and short-run R-star. Really? I can't even figure out what long-run is. Now you're telling me there's two of them.
Right.
So I don't find that conversation very helpful for thinking about policy. We just have to look at the actual data in terms of whether we think policy is tight enough or if it's not tight enough. And I think we're starting to see that it is tight enough despite what, fears that R-star is too high. But anyway, tune in Friday if you want to hear more.
Okay. Again, going beyond our gut feelings, PIIE Board Vice Chair Larry Summers gave a speech here about 10, 11 months ago, talking about the channels through which sustained increases in fiscal spending could be driving up R-star, sort of the reverse of the secular stagnation. I don't always agree with Larry, but in this case, I very much agree with Larry. We see a world where the G7 economies plus China are spending on defense, are spending on industrial policy, are spending on green tech, and are likely to continue doing that without much in the way of tax hikes. Just taking that as a reasonable projection, leaving aside Larry's comments, does that kind of fiscal path affect your thinking about future inflation, your thinking about R-star? I understand politically you're not playing a game with the fiscal authority, but in terms of longer term thinking, how does that play in?
Yeah, when I think about, again, a common measure of trying to back out what long-run R-star is just looking at the real 10-year yield over the last 40 years, and that has been falling. Now, what that means is if the yield is falling, the price of those assets are going up. People are willing to pay more for them. So the way maybe this is a very simple way, but I think of it as over the last 40 years, what we saw is the demand for treasuries was outpacing the growth of the issuance of treasuries. So demand was exceeding supply for the last 40 years. And the speech on Friday will cover a lot. I'm not going to go into detail. But if that reverses, so what happens is prices are being driven up, yields are being driven down. But if suddenly the supply of treasuries starts exceeding the growth in demand for these objects, the price will start to fall and the yield will start to go up. So it's really more the fact that it's not so much about fiscal policy per se, but if the issuance of debt and running deficits gets to the point where the issuance of treasuries starts outstripping demand, you're going to see real interest rates go up. And then that will feed back on what we think about for R-star longer term policy.
Got it. And of course, Blanchard would say that would affect R minus G, his magic calculation of fiscal sustainability. Because you were so clear and forthright, I am asking you more things about things you didn't say, and I don't mean to suggest what you said wasn't central. But one more thing, which as an alum of Federal Reserve Bank of St. Louis, I want to point out, you didn't make a big point about the Fed's balance sheet, either the size or the changes in it. So how do you regard the Fed's balance sheet policy? I don't mean, do you agree with it? I mean, do you view it as a central part of the monetary stance, as something that's secondary? Quantitative tightening matters, it's not that big a deal? Is it something that we really shouldn't be paying that much attention to? I mean, how do you think about the balance sheet?
Yeah, so balance sheet in policy, I do view in kind of an asymmetric way, and I made some comments back in New York on this earlier this year. When you're at the zero lower down and the economy's not doing well, then doing balance sheet policy to try to put downward pressure on longer term rates, I think it does have some benefit. How big that benefit is, we can argue about, but it does have some benefit. But that's usually because there's some friction in the economy that you're trying to overcome and try to help the economy. As that friction tends to go away, we can start removing that accommodation, use our policy rate to do most of the work, and then all you're kind of doing with the balance sheet is draining any excess liquidity you put into the system. So the simple analogy I like to point out is like, if you had a house on fire and you started pouring water on it, you put out the fire. When the fire's out, you drain away the water. The house doesn't start back up on fire. And that's the asymmetry I meant, that putting it in helps, it does something good, but later when that problem's over and you start taking it back out, it's really not doing that much. You're just trying to take in the excess liquidity out of the system. So that's kind of how I view a lot of the balance sheet. It's helpful when we're in a tough situation, but once we kind of get out of that, you can take it away and there's not going to be any reciprocal damage from taking it out.
Thank you very much. I actually happened to share your views, but I had not come up with, and I didn't remember you had invoked that particular analogy. As you know, markets, a lot of people in markets make a very big thing about small movements, trends in the balance sheet, so I really appreciate that perspective. So relating to that, and going back to things you did discuss in your speech, despite what you said about data dependence, there is a lot of opinion out there, not just from markets people and casual pundits, but people whose names are in play for potential Fed chair in a Trump administration or potential successor to Chair Powell, who are saying that the Fed has been quite undisciplined in the sense that it does seem to be tacking back and forth. Now, you make a case why you don't think that's a fair charge. But in particular, can we talk for a second about communication? The Fed has, as you said, largely stuck to this sort of 3 cuts roughly calendar year 2024. But the markets have swung widely from expecting 6 or 7 cuts to then wondering if there might be hikes. And now they seem to have settled at your 3. Is this a sign of at least a communications problem, if not indiscipline? Ben Bernanke, former Fed chair, in his recent report to the Bank of England, talked about maybe central banks, at least the Bank of England, could talk in terms of scenarios instead of one central forecast. Could you just say a bit more? Because even if we accept your defense of the Fed strategy, in communications terms, it doesn't seem to be going very well with vis-a-vis markets.
Yeah, so I guess I would say the following, which is in the last 30 years, the Fed has gone from saying nothing to saying a lot. And that's, I think, good. The transparency and the communication. People always say there's too much chatter. Okay, whatever. But we are trying to communicate where we think things are going. And then oftentimes, on the scenario stuff, I'll say the following. I can only speak for myself, but oftentimes I have a baseline, but I will also say, if this happens, which is not my baseline, this is how we would think about responding. Or if that happens, this is what we would do. So that is basically scenario analysis. Right. You're giving alternative outcomes for what could happen going forward and where you think policy would need to tack one way or the other. So I think most of us do that in our speeches. It may not get picked up that way, but that's kind of my intent when I do that. The one thing I've learned in this job is I can talk to everybody in this room and you all hear me say exactly the same thing and you all interpret it differently. But that's apparently my fault. So I think this is what gets lost in the communication. We could all say the same thing, but it's going to be interpreted very differently by everybody. So I can't fix that part. I'm not blaming it. I'm just saying we all hear things the way we want to hear things at times, and then that leads to what is viewed as confusion or different things, even though you all heard what I said. So that's the challenge. Everybody thinks about us communicating, but there's also the challenge of being received the same. And then the last part on this is, there's 19 members of the FOMC. They all have their views. They can all go out and say what they want. And that is the point of an independent Federal Reserve, with a diverse set of voices to go out and say, this is how I see the data. We were designed to do that. We weren't designed to sit there, shut up, and not talk about anything and have one voice. If that's the case, get rid of the FOMC, have one person.
Another thing that's changed over the years.
Yeah.
Thank you for responding. A couple days ago, I think, you gave the welcoming remarks to the Fed's conference, Fed Board and Fed New York conference on role of the dollar, yep, or on international finance. I forget the exact title. Yep. So can we talk for a moment about that? Obviously, not asking a central banker to comment on currencies, but is there some interest among the FOMC, or rather, should there be some interest among the FOMC on the pace of rate cuts at the other major, quote unquote, central banks? I mean, obviously this isn't a crisis where you need coordination, but does it matter if the Fed is ahead or behind the ECB? Does it matter if the dollar seems to be going up in a secular way, given the Fed relative interest rates? It's a perennial question, but what is your latest thinking, especially in this context where, according to market pricing, ECB, Bank of England could be cutting before the Fed does?
Yeah, so philosophically, I've always kind of taken the view, every country's central bank should do what's best for their economy, and I'll do what's best for our economy. Are there potentially some spillovers from people doing that without taking into account what happens to everybody else? Sure, that's a well-known thing in the academic literature on spillovers. Give an example, back in 22 when we were hiking rates very fast and by large amounts and other central banks started doing it, there was a general sense they're going to over-tighten, and this is going to cause a global collapse because they're not taking into account what everybody else is doing. That didn't pan out. What's funny is I don't hear it going the other way. There's over-loosening. It's always on the way up that things happen, but never on the way down. So there's no talk right now about, all the central banks around the world are going to over-loosen. So, I mean, all these kind of coordinations and things moving together, I just don't think they have that big of a spillover. The timing of when we do our rate cuts is going to be based on our data, on our state of our economy, and what we think we need to do to achieve our dual mandate. The ECB will have to do what they think is right. The Bank of England will have to do what they think is right. And again, I just don't think a lot of these spillovers are that big. I'm not saying they're zero, but they're just not big enough for me to start changing how we conduct monetary policy.
Thank you. A final question, and then I'll be turning it over to our audience, our in-person audience, to ask questions. We're grateful to Governor Waller and the team from the Fed that this is an all on the record conversation. So the final question, in the spirit of what you just said, is not so much about central bank policy, but thinking about inflation more broadly. It seems like inflation is being more persistent in the US than it's been, say, in the Euro area and a few other places. We just published a paper by Bernanke and Blanchard here at PIIE about a study they led, 11 different central banks looking at inflation. That's my alarm to turn to the audience. Anyway, just do you have any thinking on differences between the inflation processes between, say, US and Euro area, US and other economies? Or do you come out where Bernanke and Blanchard seem to come out that a lot of it is very similar? And then if that's true, is it global, is it non-national? I mean, just some thinking about the comparative outcomes, if you could.
I mean, a lot of the persistence of inflation, in kind of standard academic models, it's kind of driven by how often firms change their prices. If prices are going up, do they raise them faster than when they're falling? It's the old rockets and feathers story. Prices always go up much faster than they ever come back down. So, you have to ask, is there something different now in firms' price setting behavior that they're less resistant to, changing prices or raising prices? Firms still have to see enough market power for now that maybe they can continue passing it on, which is different than certainly 10 years ago. All I ever heard was no firm had pricing power. No firm had pricing power. Now we're seeing that they do. Is that going to make inflation much more, or inflation more persistent or stickier? Could well be. We do know that also, wage costs at some point get passed through. You talk to any small business, they'll tell you right now that's the biggest thing driving their price increases is just their labor cost. Labor costs in the US, we have much more of a competitive market. They're free to go up and down depending on how the market conditions change. Other countries, it's much more structured, much more unionized, much more contracting, much longer term, and that makes it harder to see these things pass through. But in that sense, it's really just, I think it's either some combination of the firm's pricing power and what the labor markets look like. Whether quantitatively that's a big deal or not, I'll leave that to the academics to go figure out.
Terrific. Thank you for responding to that. Do we have so we're now opening up to the audience. There's a traveling mic to come to the front table. There's a standing mic in the middle there. I'd prefer to get somebody who's not a Peterson employee to be the first question. So the lady raising her hand, if you could go to the standing mic. Please identify yourself, your name and your affiliation before asking.
Hi, I'm Rachel Siegel from the Washington Post. Thank you both so much for doing this. Governor Waller, on inflation, can you talk about this argument that's floating around that what we saw with the first 3 months of the year was actually a very lagged seasonal effect, that maybe what some had been expected to cluster in January actually floated through to other months? Is that at all something you think is reasonable? And if not, how do you think back on the first 3 months and what was accounting for those hotter prints?
Yeah, I mean, after 6 months of pretty decent data, we got this shock in January of a huge price increase. And then there was a lot of discussion. It's a seasonal, it's temporary, it's all the beginning of the year. Bunch of other factors, largely driven also by a big jump in import prices that nobody was expecting. And so it was all thought, it'll fade away. It'll disappear after months. Well, February didn't quite disappear. And then the story was, well, it'll just kind of bleed. Some of it's just bleeding through. It'll be fine. Well, in March, didn't. And at some point after 3 months, it can't be these temporary seasonal things. That there's something more fundamental that's going on in making inflation a little stickier, as Adam was bringing up, than what we saw at the end of the last year. So, that was where after the March data, we were very concerned that maybe this was not going the way we thought it was going to go. Now, this last month, like I said, the key thing for me is it's showing that inflation is not accelerating. I think we can kind of rule that one out. In January, it didn't, you don't know. And the 3 months were not looking real good. But now, how much progress we're going to get towards getting to 2%, it may be a lot slower than we saw at the end of last year. But whatever the factors were in the first 3 months, they haven't completely disappeared. So there might be something much more fundamental going on than seasonals. I don't know exactly what that would be. We're still all trying to figure out what it is.
Thank you. Please go to the mic, and then to David will be the next question.
Yeah, hi, Governor Waller. Nick Timmeros from the Wall Street Journal. You were clear in your remarks about what you would need to see to consider easing policy and that you thought rate hikes were probably unnecessary. The committee right now has a soft easing bias in its statement by laying out a guardrail for what it would take to turn towards lowering rates. And I wonder what you would need to see to say, you know what, there shouldn't be any reference to cuts in the official policy statement. There should be instead just a neutral bias. What constellation of data would you need to see to consider taking that guidance out of the statement?
Well, like I said, I think right now the probability of rate hikes is pretty much very low. I'm never going to say zero. There always could be some sequence of events where things turn in a kind of a way we would have to put that back on the table. But I just don't see that happening. I think the data is going to come in that accelerating inflation is just not going to happen. So at that point, the question is, what's the next policy move? Well, if it's not up, it's likely down, but we're not saying when that would happen. That depends on the data. So I said in the speech back in March, given how the data's been coming in, it's appropriate to push off rate cuts into the future. They don't have to happen in the calendar year, but they can be out in the future. So right now, I'd say the bias is, unless we saw some really data that inflation was accelerating, the bias is more likely to the downside than the upside. And that's just based on the economics of the data.
Thank you.
Peterson Institute, Bloomberg Economics. The framework review that was wrapped up in 2020 was a big deal. It was the first ever of re-examination of the way that the committee thought about policy, led to some important innovations in committee communication, including the longer run statement. What can you tell us about the upcoming framework, about how it will resemble the 2020 or differ from? There were a number of issues that were taken off the table right from the start in 2020. Will there be a similar list of issues taken off the table? How can you foreshadow for us what will happen in the upcoming review?
Yeah, I would say at this point, how the framework review is going to be done, how it's going to be handled, what the time frame, that's going to be up to the chair. So any comments I make is going to be front running the chair, and I'm not going to do it.
Okay, if all of you, who are physically capable, could just line up at the mic, we'll get you all in, please.
Hi, Kyle Fischel with The National. Thank you for taking my question. I want to ask about rising consumer expectations. The New York Fed last week showed consumer inflation expectations rose on the 1-year and 5-year forecast. Could you tell us how big of a concern that is to you personally in the months moving forward?
Yeah, I mean, oftentimes you'll get these bumps up in expectations when you get a couple of months of kind of bad data. So, and then when data's looking good, so inflation data was good in the second half last year, we started seeing this drift down in expectations. Then you get 3 bad months, they start drifting up. So you have to kind of wait and kind of see what the data's going to look like. If we get inflation, it's starting to look like it's back on track towards 2%. It might be slow, but it's at least moving in the right direction. You might see these numbers come back down. So I don't know how much of it to take is just because of all the attention paid to the first 3 months of the year, or whether there's something more fundamental going on.
Rich Miller, Bloomberg, thanks for taking the question. Can you speak a little bit more about the labor market? You mentioned that the traditional relationships may be coming back into play. You also highlight the fact that wages are still running higher than you thought were sustainable with the 2% inflation, and you mentioned small businesses, talking about wages. Does that imply that we do need to see some higher unemployment to, bring this economy, bring the inflation back down to, 2% on a sustainable basis? Thank you.
Well, like I said, in the work that Andrew and I did, we said getting the job vacancy ratio back down to the vacancy to unemployment ratio back down to 2019. We were estimating the unemployment rate would go up to about 4.2 to 4.4. So that's just this standard beverage curve kind of dynamics, that you would see that. And, you know, it hasn't gone up even that high. So inflation is coming down. Again, you know, hoping that April wasn't the outlier and is more like back on trend, then, you know, I can see us continuing to let inflation get closer to progress, and the economy's doing reasonably well. So I don't see that we have to have some big increase in unemployment to do that. But if inflation was, you know, running at 5 or 6%, and we were at this point, and we needed much more higher rates, then I could certainly see that would be a consequence of having to do that. No. That was the prediction of the model. That was just the point estimate off the model.
I'm just going to repeat Rich Miller's comment, because I just, no, it's fine. I just didn't want to not get here. Rich said, and you replied, but Governor Waller didn't mean that meant that you had to go up to 4.2 or 4.4%.
Yeah, it was just what the model was kind of predicting.
Great. This will be the last question. Just to note, my previous comment was not meant to be ableist. If there's anyone who's seated, there is a traveling mic. It's just convenience. Please.
Craig Torres from Bloomberg. Governor Waller, the long hold. It seems it's going to be pricing more and more people into higher interest rate debt. I think the financial system is remarkably stable, but I wonder if you think this is building in fragilities for the future if we turn lower in economic growth.
I mean, I think that's the point. We have rates are high because we're trying to pull demand down. The economy's been kind of shockingly resilient to a lot of this, and that's where people are saying the economy's less interest rate sensitive. It's good, you know, for a while there where you might have to raise rates to actually get things back on track. I mean, it is working, and we see it. I had a funny little story this weekend. I was having lunch with one of my old high school buddies. He picks me up and he said, you know, I was going to buy a new car, but when you guys jacked up interest rates, I went to look at what it was going to cost me in a monthly payment. I just said, I'll keep driving my old car. I said, sorry, man. He goes, that's okay. You're just doing your job. And so, you know, that is the thing. We are trying to put downward pressure on spending. We are trying to make it more costly for all these things to try to pull back demand. That's just the standard mechanism by which we do things. So we want to see demand softening. We want to see these things happening. We just don't want them to go off a cliff. That's the critical thing. We're not seeing anything right now that looks like staying here for 3 or 4 months is going to cause the economy to go off a cliff. So that's it.
Great. Well, thank you all, both here in person, which we enjoyed, and online around the world, for joining us today for remarks and discussion with Dr. Christopher Waller, member of the Federal Reserve Board of Governors. We are delighted to have had you back at the Peterson Institute and look forward to watching your continued contributions to monetary policy and public understanding of it. Thank you.
Thank you, Adam. Thank you all.